Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back with another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by founding partner and chief economist Don Rissmiller. Don, how are you doing today?
Very good, Ross. Good to be with you.
Good to talk to you as well. I want to start with the thing that has been on investors' minds for a while now, which is a pretty broad topic, but this topic of rates, whether the Fed is going to continue cutting this year, whether the browbeating from the administration at the Fed will have an impact on that. The Fed meets here next week. I wondered, what's your take on this meeting? What are you watching to get a sense of what comes for the rest of 2026? And do you ultimately expect, the easing to continue for this year?
That's right. I think, Ross, there is a case to be made that the Federal Reserve still has some work to do to get the Fed funds rate to a neutral setting. That's probably slightly below where we are now. But those cuts are not going to come about because of what the White House is doing. They're going to come about because of the inflation data. They're going to come out because of worries about unemployment. The traditional dual mandate that the Fed always watches. That's the reason why policy should be in a neutral setting here, not a setting that creates stimulus for the economy, but not a setting that restricts the economy a whole lot either. So the January meeting is one where there's probably not enough clarity on the data to make a move. And I think this was reasonably well set out over the last month, given the FOMC press conference that Fed Chair Powell did, and given the Fed minutes. So we're looking for a January skip, and that will mean later in 2026, we'll see some policy adjustment. So the Fed waits for now. It doesn't help with what's gone on in the political sphere. That's creating some additional concern. But the primary drivers here are not that. It's the underlying mandate. It's the economic data. It's inflation and unemployment.
Yeah, and you mentioned that Fed policy doesn't necessarily need to be stimulative here. Obviously, there's a lot of stimulus coming from other parts of the policy sphere, a lot of fiscal stimulus. And then we've recently seen some affordability pushes. And I want to get your sense of kind of the broader state of the housing market. We know the administration is working to push mortgage rates lower. We've seen mortgage rates come down. We've started to see some evidence that the housing market might be emerging from kind of a mini recession here. But I want to get your sense of the state of the housing market in 2026 and what more is needed to unlock that portion of the economy that has really not participated in the expansion over the last couple of years.
Well, Ross, that's right. There are parts of the economy that have been doing okay. We could think about AI CapEx, for instance. But the housing market, especially housing turnover, has really been pretty lackluster. If we look at existing home sales, a normal year for existing home sales would be something like 5.5 million. A good year could get up to 6.5 million. We saw that in 2021, for instance. But the last 3 years, existing home sales have been roughly 4 million. So it's an extremely low level. Now, there's a mortgage rate lock-in effect at play. So somebody who had a 30-year fixed rate mortgage that was low relative to the current rate is probably staying put. So as rates come down, you'll get a little bit of relief there. You probably won't get complete relief. And so housing is going to be a source of tension over the course of this year. There's limits to what the administration can do by themselves, though. The problem in the housing market is really one related to supply. We want a supply increase of affordable homes near jobs. And so some of the proposals that come out of the federal government, and this administration as well as the prior administration, tend to focus more on the demand side. So if you have a tax credit for home ownership, for instance, but you don't change the underlying supply dynamics, what that's very likely to do is bid up home prices, and so you won't solve your affordability issue. There are a variety of other proposals that have been put on the table, a 50-year mortgage, changing how Fannie Mae and Freddie Mac interact with the market, and looking at mortgage portability. So there's a lot that's out there. We will probably make some attempts, but I'd take any policy that we see and ask, is this a supply-based policy or is this a demand-based policy? And the hope is we increase the supply of affordable units in the right places. That's where we'll make the most progress at getting the housing market to normalize.
Absolutely. I want to end with a spot of optimism or positivity. We started the year with a really nice productivity report, above expectations print for productivity, which is just kind of output relative to input. So how efficient are we at producing things, goods and services in this country? We've had a nice pop in productivity. There's a lot being laid at productivity's feet in terms of AI, in terms of getting debt to GDP under control. What did you see from that report, and do you have any optimism that it can continue and maybe the back half of this decade can be one of above trend productivity?
Ross, that's a critical question, and there are some reasons for optimism at this point. So if we look at productivity gains throughout history, a good period, a productivity boom, would be something like 2.75% productivity growth annually over the course of a decade. So it has to be elevated, and it has to be something that's maintained over time. Now, what we have in the last few quarters is elevated productivity. So not just 2.75% productivity growth, but the last quarter was closer to 5. The issue is whether it can be maintained over time. And so that's the other characteristic of a productivity boom that's still an open question. There are certainly encouraging signs in the recent data. We do have a credible story with AI and CapEx and technology. This is probably the most credible tech story we've had in 15 plus years. There have been other tech stories, but they've either been too niche, something like 3D printing did work, but it was not economy-wide in its implementation, or there were other stories that fizzled. We could think about Web3. We could think about the metaverse as other tech stories that never really played out. So we do have a credible source of productivity growth, and I would be optimistic that we're going to see a continuation of that trend. Maybe not 5% productivity, but we don't need 5. If we can do 2 to 3, 2026 will be a good year.
Don, that's great insight. I want to thank you so much for your time as always, and we will look forward to talking to you again soon.
Thanks, Ross. Take care.